Okay, this video covers accounting for contingent liabilities. We all know what a liability is. A liability is a probable future economic sacrifice. Contingent means it's pretty uncertain. That's what contingent means. It is contingent on future events. And so right now, the liability is uncertain, whether it exists or not. And so we'll talk about how to account for this type of uncertainty. And here is the accounting rule. So first we'll talk about the accounting rule and then we'll go through some examples. So the accounting rule for contingent liabilities. Again, a contingent liability is a loss that may occur in the future. Examples of contingent liabilities include lawsuits, warranties, earnouts, indemnification agreements, and there are perhaps others as well. And the rules are, a company must record the liability if it is probable and reasonably estimable. Okay, and the definitions are down below. So probable means the future loss is likely to occur, and reasonably estimable means the future loss can be estimated. Okay, so that's when a company is required to record a liability for this possible future loss. What do we mean by record a liability? Well, we mean credit a liability account, and then the debit would be to a loss account on the income statement. So when do we need to recognize a loss on our income statement and reflect the liability on our balance sheet? Well, we need to do that when the future loss is probable and reasonably estimable. Now, down to point 2. So if it's not probable and reasonably estimable, well, if the future loss is only reasonably possible, you can just disclose it in the footnotes. So there's no journal entry that needs to be happening. All you need to do is disclose this possible loss. You need to disclose that fact in the footnotes. Reasonably possible means the chance of the future loss occurring is more than remote, but less than likely. So that's what reasonably possible means. By the way, if the loss is remote, so the third bullet point here, there's no need to disclose anything. So if this is a frivolous lawsuit that has no basis, just don't even bother investors with it. It's going to go away. And if the probability of the loss is remote, you may just ignore it and not report anything about it in your financial statements and footnotes. Okay, so these are the accounting rules. The key for this class, we care about when the companies are recording liabilities because we care about the balance sheet and we care about the income statement. So the main rules we're going to be looking for is whether the loss is probable and whether the loss is reasonably estimable. So let's look at an example. And the first example we'll look at is a contingent lawsuit. So this the example has to do with Equifax. And Equifax is a company that has lots and lots and lots of information about you and me and everybody. It has our social security numbers. It has some of the credit transactions that we do. And it has lots of information about our credit worthiness as human beings in the world. And so that's the type of data Equifax has. And they were breached. So somebody went and stole all of that information, and it affected a lot of Americans. And so what happens then? Well, people sue Equifax, and there's a class action lawsuit against Equifax. And so this was all occurring kind of during 2018. And so on June 30th, 2018, Equifax had to file financial statements. And it's like, should we accrue a loss? Because we're probably going to get sued and we're probably going to lose. So should we have a liability on our balance sheet? Should we have a big loss on our income statement? That's the accounting question. And here's what they state. While we believe it's reasonably possible that we will incur losses associated with these proceedings and investigations, it is not possible to estimate the amount of the loss or the range of possible loss that might, and then it goes on to say occur. I think I left that word out, might occur. So what are the key words here? Reasonably possible, and it is not possible to estimate. So when they say it's reasonably possible we will incur a loss, what they are not saying is that it is probable that we will incur a loss. And you might disagree with their judgment here, that they're saying it's reasonably possible, but it's not probable. You might disagree with their judgment as of June 30th, 2018. But think about it from a lawyer's perspective. And this is something you have to be aware of when you read companies' disclosures. What would a court of law think if in a company's footnotes they are saying it's probable that we're going to lose this lawsuit? a court of law might conclude that that is a statement of guilt by the company. So the company, now I don't know this for sure, but a company may be trying to avoid that type of judgment by being overly generous to themselves in their disclosure. So they might say it's reasonably possible, even though the loss is probable. I mean, you lose a lot of people's information and you're probably going to be sued successfully. And so, okay, they decided with reasonably possible. And even if they decided it was probable, guess what? It must be probable and reasonably estimable, because you need to know what amount of the loss it's going to be. Otherwise, you can't record a journal entry. So not only is it not probable here, but it's also not possible to estimate the amount of the loss. So it's not reasonably estimable either. That's why on June 30th, 2018, Equifax did not record a liability for this loss. So if you were an investor and you're not really reading the news and you don't know what's going on with Equifax, and their balance sheet and income statement comes out and it looks just fine. I mean, there's no liability on there. There's no loss on the income statement. You might incorrectly assume that they're going to be just fine, when the truth is they're probably going to have a loss in the future. They just don't know what the amount of the loss is. So that's why they have this in the footnote to warn investors that it is reasonably possible a loss will occur. Okay, well, let's fast forward 1 year to June 30th, 2019. And here now that things have developed a little bit and the picture has become more clear that a loss will occur, here's what they've said. They said now they believe it's probable that they will incur a loss associated with these proceedings related to this 2017 cybersecurity incident. And they recorded an accrual. An accrual is just a liability that is going to result in a future cash payment. So accrual means that the cash payment is going to happen at a different time than we're recording the liability. That's an accrual. So they're going to record a debit to the income statement of a loss and a credit to a liability account on the balance sheet of $701 million. And that's for the estimated probable loss that they will have in the future. And where are they recording that on the income statement? Well, they're recording it in the salary, general, and administrative expenses line item of their income statement. Okay, so that is how the contingent liability went from a possible, reasonably possible, to probable. And once it became probable, they recorded the liability. Okay, next example we'll go through is contingent consideration, which is when a company does an acquisition of something. And so this company, AbbVie, did an acquisition. They acquired 2 drugs and they acquired a company. And there is some expertise of the people in this company and associated with these drugs. And they wanted to make sure that they wanted 2 things. First, let's keep these people involved. Let's keep these people committed to the success of the drugs in the company. That's what AbbVie wants, because they don't just want to acquire intellectual property. They want to acquire, people who are committed to seeing the intellectual property into a profitable asset. That's number one. They want to keep people working. Number 2 is they want to have some sort of a hedge in case this asset that they're buying doesn't work out. They want to pay less for it. And so that's what this contingent consideration is all about, otherwise known as an earnout. And so let me just read the details of it. AbbVie, so with respect to the drugs, AbbVie may make additional contingent payments upon achievement of defined development, regulatory, and commercial milestones, as well as royalty payments based on the net sales of a licensed product. So if the drugs are more successful, we'll pay more for the drugs. That's contingent consideration. And with respect to the company, the former holders of StemStrix securities, so the former owners of the company, were buying them out, but they will be eligible to receive an aggregate of up to $4 billion in milestone payments if certain developments and/or regulatory milestones are achieved by eligible StemStrix compounds, including those things. And so if hey, we're going to buy the company from you, but if what we bought turns out to be a really good deal for us, we're going to share some of that upside with you. So that's a contingent consideration. So AbbVie is going to record a liability. And the liability is based on the probable and estimable future payouts that they're going to make to these entities that get to share in the upside after they sell their interest in these assets. And so this amount is up to 1.8 billion. This amount is up to 4 billion. So total of up to 5.8 billion. And let's see the liability that AbbVie recorded. So they're tracking this liability over time. At the beginning of 2018, for example, they were estimating the value of this liability to be 4.5 billion. So almost, more than half of the way to the 5.8 billion total. That's the amount of the liability they recorded at the beginning of 2018. They also had some change in the fair value of the liability. So it either increased because it's getting closer to the payout. So it's a higher value of the liability, or the probability of making that payment got greater. And so they increased the value of that liability. They also made some 100 million in milestone payments. So that reduced the liability when they made payouts. And so the ending balance of the liability is $4.483 billion. And so AbbVie is just kind of tracking this liability over time. You can see this is a beginning balance and ending balance for each of the previous 3 years. And as the probability of the liability becomes greater, or as the present value of the liability becomes higher because you're getting closer to paying it out, they're increasing the liability and charging that to expense. And as they make payments, they're crediting cash and debiting the liability here as they make payments to reduce the liability. So that is the second example of a contingent liability. And I hope you enjoyed going through those examples and learning about that accounting rule. And I'll see you in the next one. Bye-bye.